All right. Hi, everyone, and welcome to our webinar, Investing in an Election Year. I'm Leslie Garrison. I'm the Chief Operating Officer at Cornerstone Wealth Management, and I think we have a really great topic for today's webinar. It's definitely a timely topic. It would be difficult to not have some interest in the presidential election this November. Needless to say, we've seen some very historically significant events for the past few weeks. And thanks to our friends at JP Morgan, we're going to discuss some of the issues that will be decided, along with what those mean for investors. And before we do, I'd like to give a brief introduction to Cornerstone Wealth Management, because there is a chance that you may not know who we are. Cornerstone is a registered investment advisor and a group of independent financial advisors. We are based in St. Louis, Missouri, but we have about 125 advisors spread out over 15 states. We were founded in 2005, and our advisors manage about $8.5 billion in client assets. They also serve almost 55,000 individual clients. One of the reasons you may not know who Cornerstone is because your advisor uses a brand name other than Cornerstone. As you can see, we have advisors using many different names for their independent financial advisory practices, even while still being under the Cornerstone umbrella. All of our advisors are registered with LPL Financial. LPL is the largest independent broker-dealer in the country with over 23,000 financial advisors and over $1 trillion in client assets under management. LPL custodies assets for your accounts. They provide account statements as well. And LPL gives advisors access to the investment product inventory to accomplish your goals. Because your financial advisor is connected with Cornerstone and LPL, they can outsource many functions of running the day-to-day of their business. And that means that they get to spend more time with you, their client. This webinar is a great example of that. Cornerstone's done the planning, and your advisor can simply invite you to gain some insights from a very knowledgeable speaker. And now, one bit of housekeeping before we get started. If you want to ask a question, please email this email address. It's cornerstonewm@lpl.com. Due to compliance reasons, we can only accept questions that are sent to this email address. Again, it's cornerstonewm@lpl.com. We'll repeat that again later in the webinar. And for now, let's move on to the main event. I will turn things over to our local JP Morgan representative, DJ Harris, to introduce our speaker.
Thank you very much, and we are delighted to be part of the activity today. I'm excited because I love listening to Jack share his thoughts and information, and an important part of communication, our market strategy, our market views, and certainly, as Leslie mentioned, the election year being kind of a top of mind topic right now. I think it's perfect timing for such. So Jack's been with us since 2013, graduate of the University of Chicago, I believe, and been in his current role with our market insights team for 6 years now, since 2016, excuse me. So 8 years, almost 9, Jack. Time flies. But if you've seen Jack on CNBC or Bloomberg Business Network or multiple other outlets, you might have seen his name show up in a couple of press releases as well, and some quoted in the press. But an important part of our research and our team is the Market Insights group. We publish a publication called Guide to the Markets that's updated daily, but refreshed quarterly. And Jack has some slides from that he's going to use. I don't want to take up too much of his time, but thank you for your time today, Jack. Thanks to Cornerstone for the opportunity to be a part of this. And I'll mute myself now and turn it over to you, Jack, to kind of walk us through the slides. And Leslie's in control, so when it's time for another slide, just maybe mention the next slide, or if you want to move on, etc. And we'll go from there. Thank you.
Okay, well, that sounds good to me, DJ. Thank you very much for the introduction. And Leslie, thank you very much for emceeing and hosting. And thank you, everybody, for taking some time to dial in to talk about I mean, I'll go out right out and say it, probably my least favorite subject, which is talking about the election. And it's not that this stuff isn't interesting; it certainly is. But we know that you never make everybody happy by talking about politics. You never make everybody happy by talking about the election. And so we struggle on this team as a team that is focused predominantly on investments, on macroeconomic data, to be able to take what is otherwise a pretty unpleasant conversation, depending on who you are or who you're talking with, and make it a little bit less passionate, right? Sort of strip a lot of the emotion out and just focus in on those things that are going to matter most to us as investors. That is the purpose of today's presentation, this concept of investing in an election year. And as DJ said, there are a handful of slides that my team has pulled together to help us to have this conversation. I'll first talk a little bit about some of the milestones that will exist throughout the rest of this year and the rest of this election cycle. Talk a bit about the policy implications next of what we can expect out of this election, and then close with some kind of high level evergreen commentary on what it means to invest not just in this election year, but really in any election year. That should all take maybe 20, 25 minutes or so of your time, and then we can open things up for questions at the end if there happen to be any from the group. So with that, Leslie, let's please turn to the first page of this presentation. Thank you. I'll spend just a brief moment here. A helpful visual, I have to say, when looking at the 2024 election. This is the timeline, and you can see today is August the 21st. In the middle left portion of this page, the Democratic National Convention wraps up tomorrow, August the 22nd, which means we are now 2 conventions done with, right? We have the official nominees from both parties, the official VP nods from both parties. We're about to round that curve and end up in the home stretch. Presidential debates beginning officially in September through October of this year. Particularly interesting now that Joe Biden is off of the ticket, Kamala Harris is on the ticket. We will have a debate between her and Donald Trump imminently. November 5th is, of course, the election day when we all go and cast our votes. December the 17th is when the Electoral College officially casts their votes. And the 20th of January in next year is when the next president is officially sworn into office. Now, undoubtedly, right, especially with some of the events over the last couple of months, most of the attention right now is being paid to the presidential election race. And if we look at the next page here, while I cannot hope to comment on who will be president come November, the race is clearly very tight. The betting odds are continuously changing, and there is a lot more ground to cover between here and November 5th. One of the things that we can remember is that only a few states typically determine the presidency. This page looks at the 2020 Electoral College map for that presidential election, and we know that there are a handful of states that are going to go one way and a handful of states that are going to go another, right? I mean, California will go blue, Washington will go blue, Hawaii will go blue, Alaska will go red, Texas red, Florida red, right? There isn't a whole lot of ambiguity in where some of these states are going to go. Ultimately, where the attention needs to be paid is to the battleground states, the tightest races of the election. And we show on the bottom right side of this page those 5 tightest races from 2020. Georgia, Arizona, Wisconsin, and Pennsylvania all going blue, with Georgia's election being particularly interesting, if you remember that one. North Carolina going red. And now we show here, right, the spreads of votes, the margins of victories. And what you can see here is that in some of these cases, the spreads are so tight that, in effect, the equivalent of a small town decides the entirety of the Electoral College votes for that one particular state. Less than 12,000, fewer than 12,000 votes in the state of Georgia, just over 10,000 votes in the state of Arizona. The nature of the Electoral College means that for the overwhelming majority of countries in the Union, it is a winner-take-all system. We are talking about very thin margins of victory in a very small handful of states. Again, I cannot tell you where exactly the presidential election will go, how it's going to shake out, who will be president. That is not the point of this call. I am not Nate Silver. We are not doing betting odds on this presentation, but it is just a reminder that if you are trying to game out what will happen with the presidency, you can really narrow your focus and pay attention to just a small handful of races. Now, if we look at the next page here, that matters, right? Because when we think about potential policy proposals for both sides of the aisle, Democrats and Republicans, there are only a handful, which I have starred here on the left hand side of this page, where the president has unilateral authority. In other words, areas where the president can have a meaningful impact without any sort of congressional approval or intervention, right? And the three where the president has a whole lot of singular authority are in trade, immigration, and energy. Now, on the trade front, trade has been determined as a matter of national security. What that means is the president has a whole lot of authority over tariffs that are implemented on foreign goods. Now, one of the things we know is that no matter what side of the aisle you're on, being tough on China is bipartisan. So no matter what happens in November's election, whoever the president is will likely continue some sort of status quo tough on China rhetoric. However, if a Republican were to get elected, in this case Donald Trump, we might see an increase in those tariffs on imports from China and an introduction of baseline tariffs for all imports into the United States, regardless of where they're coming from. On the immigration side of things, the president has no ability, of course, to set immigration law. Congress does that. They do, however, have the authority to dictate how strictly immigration law is enforced. We know that under Donald Trump's presidency, immigration laws were enforced quite strictly. We know that the enforcement of those laws was loosened up considerably under the Biden administration, although tightened somewhat recently. We can assume that under a Harris administration, we might see some stricter deterrence measures, but generally speaking, we will continue to pair legal pathways for migrants with those deterrence measures. Meanwhile, if Donald Trump is re-elected after his previous term, right, ending in 2020, we would likely see stricter immigration measures, including perhaps an effort to deport asylum seekers either back to their home countries or to intermediate countries. And then finally, on energy, I think that the current administration is a great example of what a president can accomplish through executive action. Remember, first 100 days out of the gate, Joe Biden issuing a series of executive actions that were somewhat hostile towards the fossil fuel industry, canceling Keystone XL, the banning of new fracking on federal land, a mandate for the vehicle fleet sold in this country to transition to electric in the not so distant future. These are examples of things that the president can do without any sort of congressional approval. We would expect a continuation of that stance under a Harris administration. We would expect to see a number of those provisions eliminated or rolled back under a Trump administration with an increased reliance or push towards U.S. energy independence through domestic fossil fuel production. Outside of those three things, though, basically everything else on this page is under the purview of Congress, which means if you're trying to figure out what policy is going to look like for anything that's not trade, immigration, or energy, you have to have a view on what's going to happen with the congressional elections this November. And if we look at the next page here, while, of course, just like with the presidency, I have no idea who's going to win. I don't know what the composition of Congress is going to look like. One of the things that I do know is that this has become a very divided country. Politics have become extremely tribal. And the way that is reflected is in very narrow margins of control for both chambers of Congress. The Democrats control the Senate by the skin of their teeth. The Republicans control the House by the skin of their teeth. And yes, maybe the Senate will flip now that Joe Manchin has stepped down. Maybe the House of Representatives will flip. I'm not sure, but I have a very hard time imagining that the balance of power is going to flip in such a meaningful way that you will achieve some sort of legislative mandate. And as a reminder, you need 60 votes in the Senate to beat a filibuster, and 2/3 of the votes in both the Senate and the House of Representatives to beat a presidential veto. Red, blue, wave or not, it doesn't matter a whole lot. I have a hard time imagining that we will see a mandate emerge in the aftermath of November's election. which means that any sort of policy change coming down the pipeline that goes through Congress, which again is going to be a lot of them, will require some form of bipartisan cooperation or will have to happen as a result of momentum, for lack of a better term, which allows us to really focus in and hone this discussion in on the few things that satisfy those requirements. And turning to the next page here, one of those things that, of course, is going to be top of mind will be tax policy, if only because at the end of next year, a handful of key provisions from 2017's Tax Cuts and Jobs Act are set to expire. We show those on the right-hand side of this page, most of them having to do with individual and household tax rates, the reduction in federal income tax rates across the board, the increased alternative minimum tax exemption, the increased child tax credit, doubling of the estate tax exemption, the expansion of standard deductions, all of these things on the chopping block in the absence of congressional intervention. Now, there are some things on this page where I'm sure there is bipartisan support. Democrats and Republicans can probably both agree on the lower federal income tax rate for lower earners or lower income individuals in this country. They can probably both agree on the increased child tax credit. What they probably cannot both agree on is the doubling of the estate tax exemption or the reduced federal income tax rate for the highest earners in this country. In other words, there is a lot of momentum for tax policy to change at the end of next year. Unless we see some sort of miracle where there is a supermajority that emerges for either side of the aisle, we are likely going to see some taxes go up at the end of 2025, kind of regardless of what happens in November. Turning to the next page here, another thing we have to acknowledge, and in a similar vein, is that it doesn't matter what side of the aisle you're on, Democrat or Republican, both sides of Congress, both sides of the aisle in general, like to spend money that we do not have. Deficits are going to widen and the debt load will increase. Now, a lot of people like to approach this issue by looking for some sort of magic number where all of a sudden this stuff falls apart, whether it's a dollar value or a percentage or a ratio. That is not the way to think about this. I would argue that the better way to think about this is to look at the left-hand side of this page. Acknowledge that for every dollar that the federal government spends, about 13 cents of it goes just to paying down that debt. And as we continue to issue more debt and finance it at higher interest rates, that slice of the pie is likely going to get bigger, which means you have to crowd out spending in something else. Where do you make the cuts? Well, it's probably not going to be defense. That is a bipartisan subject. It probably should be, to some extent, Social Security and to some extent, Medicare and Medicaid. Those programs are not functioning the way that they were designed to function when they were introduced in some cases around 100 years ago. But no politician will run on the platform of slashing your benefits. So even if they are adjusted, they won't be adjusted quickly. It'll happen very slowly. And really all that you're left with once you strip out those things is that purple bar, which is creatively called non-defense discretionary spending. And that money has, at least in part, been earmarked for things like bridges and roads and tunnels and hospitals and housing and schools, money that ultimately goes towards making us more productive. And we need investments in productivity right now because demographics are working against us. The population is aging, the birth rate is declining. We need to be able to give our shrinking workforce better tools. And if we are not investing in those things because all that money is being diverted just to paying down the debt that we keep on recklessly building, well, then we might be looking at steady state, weaker GDP growth in the future, coupled with higher interest rates, which could in turn translate into lower structural equity market returns. A struggle that we might have to deal with as long-term investors, no matter who wins in November. Turning to the next page here, the third, I would say, policy item that we can somewhat count on, as I alluded to earlier, is that no matter what happens in November, we will continue to be tough on China. And that is reflected in a reorganization of supply chains that has been ongoing for almost, I don't want to say almost 10 years, but 7 or 8 years at this point. We show on the left-hand side of this page, U.S. goods imports by location. And the red line here I want to draw everyone's attention to represents imports from China. That number has been plummeting since Donald Trump launched his trade war in January of 2018. Now, a lot of people think that because we are importing less from China, we are in the process of deglobalizing. But that is not the case. And you look at that chart on the left hand side of this page, in 2023, the United States imported more goods from Europe than it did from China, more goods from Canada than it did from China, more goods from Mexico than it did from China. And our imports from Vietnam, Korea, Taiwan, and India are all steadily ticking higher. We are not deglobalizing, but instead re-globalizing. And while the world moves away from China as the sole source of cheap goods and cheap labor, all these other countries are lining up to pick up that mantle of responsibility. It does not matter what happens in November, this trend will continue, opening up some interesting investment opportunities if we are long-term investors considering allocations outside of the US. And now to turn to sort of the final portion of this talk, what are some high level ways to think about investing in an election year? Well, the first thing I would say is that markets don't like uncertainty. Election years are profound sources of uncertainty, and elections themselves almost always reduce that uncertainty. And that uncertainty translates into volatility. And this year, as we know, has been a lot more volatile than most. We had a debate performance between President Biden and former President Trump that ended up not going the way that Democrats would have liked. A week later, an attempted assassination on former President Trump. Then a week later, Joe Biden is diagnosed with COVID, and a couple of days later drops out of the race. I mean, this has been an even more uncertain presidential election year than typical. But one thing we need to remember, right, is that markets don't care a whole lot about who wins. They just want to know the outcome so they can plan for or around any potential policy change coming down the pipeline. And history has been a pretty good guide in showing us that once election day comes and goes and we know what government will look like over the next 2 years, markets typically come down and move higher. So don't be surprised by all the volatility that is going through the markets this year, and look forward to election day as that sort of light at the end of the tunnel. The second and last thing I'd like to share on this front is on the next page here, which kind of brings us all back to the beginning of the conversation. You know, this industry in election years always ends up spending a lot of time telling you to not worry a whole lot about elections, right? That over the long run, markets go up, the economy grows, it doesn't really matter. And there is plenty of evidence to support those lines, but it also feels somewhat unsatisfying, certainly, but also a bit disingenuous. I mean, how can you tell me that policy does not impact market performance? The reality is that policy does. It does matter. It matters a lot. It just doesn't operate in a vacuum. There are a lot of other things going on around the world that can just as significantly influence market performance. And I don't think there is a better chart to prove that point than this page right here. It looks at the performance of the S&P 500 energy index in gray, think of that as traditional fossil fuels, versus the S&P Global Clean Energy Index in green. And the performance of these two indices and themes, we should say, under first the Trump administration and second the Biden administration. Now let's pretend for a second you haven't seen this slide. Knowing everything that you know about Donald Trump and Joe Biden, about the Republicans and the Democrats, what do you think would have outperformed under the Trump administration? Fossil fuels or clean energy? And then once Biden got elected, what do you think would have outperformed, clean energy or fossil fuels? I mean, I would have guessed under Trump that fossil fuels would do better. Under Biden, clean energy would do better. I mean, how could you not think like that? And yet, in fact, the opposite occurred. Under the Trump administration, fossil fuels did quite poorly and clean energy did quite well. Under the Biden administration, clean energy did quite poorly and fossil fuels did quite well. And it's not because policy doesn't matter. It's not because these two administrations didn't do their hardest to push their respective agendas. It's because there's a lot more going on around the world. Like, yes, in his first 100 days of office, Joe Biden canceled Keystone XL and banned new fracking on federal land. But we also had interest rates move up more aggressively than they had in half a century. A war breakout in Eastern Europe between two commodity-rich states. A war breakout in the Middle East surrounded by petro states. and China reopening its economy post-COVID with an enormous amount of demand for fossil fuel products. All of this means that policy agendas can have actually very little bearing on sector performance, and we shouldn't let how we think about politics influence our investing decision. With that, Leslie, I think I will pass things back over to you. But thank you all very much for the time and the attention. I hope this was helpful. And if there happen to be any questions from the group in the next few minutes, I would be very happy to take.
Thank you so much, Jack. It looks like you do have a QR code here. If you want to access Election Insights, you can scan that with your phone and get access to that as well. Really appreciate your time and all the information. That last slide was especially insightful and a really good reminder. We don't have any questions just yet, but as a reminder, if you do have a question, you can email it to cornerstonewm@lpl.com. Jack, I do have a question. You mentioned that likely both parties may increase, are going to continue to be tough on China. Trump is looking at increasing tariffs kind of more broadly. What kind of economic impact might that have?
Yeah, it's a great question, Leslie. In theory, tariffs are inflationary because they would increase the cost of goods. And the United States is an import-driven economy. There are lots of things that we buy that simply are not made here and cannot be made here for cost reasons that would become more expensive. However, this is also an economy that is driven much more by spending on services than on goods. And while good costs feed through into services costs, there is an extra layer there that is a bit more insulated from tariffs, right? The labor costs might not be as insulated. So I would say that tariffs could be mildly inflationary, not significantly inflationary, but mildly inflationary. May encourage some increased domestic production of certain goods, but I think it would not really do a whole lot good or bad for the economy looking forward.
Thank you, Jack. I appreciate it.
Sure.
It doesn't look like we've gotten any questions from our attendees today, so I think we will go ahead and wrap things up. If you do have questions, feel free to continue to send them in here, and we'll see if we can't ping Jack and get his answers for
Sure.
you.
Forward any email questions you receive on to me, and we'll get them to the team.
Sounds great.
Thank you.
Well, DJ and Jack and everybody who tuned in, we appreciate your time. Thank you so much, and we'll see you hopefully at the next webinar.
Thank you.